Welcome to the Deep Dive, your go-to for concise breakdowns of the latest earnings calls. Think of this as your personal cheat sheet to being genuinely well-informed, without drowning in all the data.
Exactly. We cut through the noise.
Today, we're diving headfirst into KE Holdings, Inc. You probably know them as BEKE. They're a huge player in the Chinese real estate platform space.
Dominant, really.
We're dissecting their second quarter 2025 results. And this isn't just like a routine earnings call. It feels pretty pivotal. They're navigating a really seismic shift in the market over there.
Yeah, big changes happening.
So what did management actually reveal, and what does it really mean for their future? And maybe for you listening, let's unpack this.
Okay, so let's start with the headline figures. KE Holdings reported an adjusted EPS of RMB 1.55. That translates to about US $0.22 per ADS.
ADS being the American Depository Share?
Correct. And interestingly, that actually beat analyst estimates. So, a positive signal right off the bat.
Okay, a beat on earnings. What about revenue?
Revenue, however, came in just a little shy of consensus. It was RMB 26.0 billion. That's US $3.63 billion. Still, it marked a respectable 11.3% year-over-year increase.
So a beat on earnings, slight miss on revenue, but still growing year over year. But I saw the profitability picture looked, a bit more challenging.
That's putting it mildly. Yeah, the gross margin saw a notable decline. We're talking 600 basis points year over year.
Wow, 6 full percentage points.
Exactly, landing at 21.9%.
Yeah.
And the adjusted operating margin, that nearly halved, dropping from 12.0% last year down to 6.2%.
Oof. That's a significant squeeze. What's the immediate read there, given, the top line wasn't terrible?
It is a big shift. But what's fascinating, connecting this to the bigger picture, is that despite those margin pressures, the board really underscored their confidence.
How so? Just talk or?
No, they backed it up.
Yeah.
Big time. They dramatically expanded the share repurchase authorization to a massive US $5 billion.
$5 billion.
Yep, and they extended it all the way out to August 2028.
Okay, that's a long runway.
It is. And you couple that with their pretty healthy cash reserves around RMB 70 billion. This isn't just routine. It signals a really deep commitment to shareholder returns and, frankly, a belief in their own strategy, even with all the market turbulence.
It's like they're saying, look, we know the margins are squeezed short term, but trust the process. Our stock's cheap.
That's pretty much the message, yeah.
That extended buyback certainly sends a message. Makes you wonder what's giving them that conviction internally. Let's dive deeper then. What drove these numbers specifically? GTV.
Right. Total gross transaction value, or GTV, grew 4.7% year over year. That came in at RMB 878.7 billion.
Okay. And how did that break down between existing and new homes?
Existing homes GTV saw a, modest 2.2% increase.
Yeah.
New homes GTV rose by a more robust 8.5%.
But the real story, that strategic pivot you mentioned, it seems to be all about diversification, right? I saw non-housing services hit a record share of revenue.
Absolutely. Home renovation and furnishing and home rental services reached a record 41% of total revenue.
41%. That's huge. That's not just a side business anymore.
Not at all. And this isn't just diversification for the sake of it. These segments are becoming, foundational. Take home rentals. They surged an impressive 78.0% year over year.
78%. Wow.
To RMB 5.7 billion, a new record. And that was mainly driven by a huge increase in managed rental units. They're now over 590,000.
Up from what?
Up from about 310,000 just a year ago.
Incredible growth. And renovation.
Renovation and furnishing also showed solid growth, up 13.0% year over year to RMB 4.6 billion. And what's critical here, it's not just growth. The contribution margin for rentals actually improved by 2.5 percentage points to 8.4%. And renovation's contribution margin was up 0.8 percentage points to 32.1%.
So they're getting more efficient in these new areas as they scale.
Exactly. They're not just growing, they're seemingly getting better at it.
And this rapid growth, it's effectively plugging the gap from a decline in the traditional business.
Pretty much. It's offsetting an 8.4% decline in existing home revenue. That's a major takeaway for anyone just watching the traditional brokerage space in China. It screams, a conscious effort to build new, maybe more resilient revenue streams.
Okay, so back to that profitability hit. We talked about the 600 basis point drop in gross margin. That was largely because of this mix shift towards these lower margin services like rentals.
That's a big part of it, yeah. Even with the improving efficiency within those segments, their overall margin profile is lower than traditional brokerage commissions.
Makes sense. Anything else contributing to the margin pressure?
They also mentioned increased fixed labor costs, partly due to agent welfare improvements, which is interesting, and R&D expenses jumped significantly up 25.6% as they funnel serious investment into AI.
Okay, so it sounds like a deliberate strategic trade-off, sacrificing some margin now for diversification and future tech-led gains.
Precisely. And that leads us right into management's core message on the call. They talked a lot about a significant strategic pivot, a shift away from just pure scale-driven growth towards efficiency-driven development. And AI is positioned right at the heart of that.
AI is the key to unlocking productivity, basically.
That's the bet they're making.
And this is clearly their answer to the softening real estate market and, changing consumer needs over there. The CEO, Mr. Stanley Pong, specifically highlighted using AI everywhere.
Yeah, for agent productivity, lead conversion, operational leverage, the works.
And they mentioned specific tools, didn't they, like LICO?
They did. LICO is their AI-driven CRM, apparently used by over 335,000 brokers across 69 cities.
Wow.
And they claim that with a penetration rate over 75%, it boosts conversion rates for getting exclusive listings mandates by 30% and for showings by 20% for agents who use it frequently.
Okay, that's concrete impact, not just buzzword.
Right. And it's not just internal tools for agents. They also talked about their consumer-facing AI system, Pangaea.
What does that do?
It provides market analysis, home searches. It's reached 780,000 monthly active users, which is up 10% from June. And people are apparently spending more time on it. Average time spent per user is up 14%.
And the long-term vision, more AI.
Yeah, they even mentioned a plan for a whole new AI-driven rental platform trying to transform that historically, very offline, non-standardized industry.
That's ambitious. Can AI really standardize rentals? Or is it more about making it more efficient?
That's the billion-dollar question, right? But they seem determined to try and bridge that gap using tech.
Let's zoom in on how they're actually doing this, the operational improvements. You mentioned renovation. What are they doing there?
So in renovation, they're trying this community-centric model. They're opening full-service premium stores, often right next to their existing brokerage offices.
Convenient.
Yeah. And they offer modular products and, importantly, pre-signing measurements. The idea is to build trust by being really clear upfront about what the customer gets.
Smart. Has it worked?
Apparently, yes, especially in Beijing. They said the operational margin for renovation there rose from just 5% in the first half of 2023 to over 11% in the first half of this year, 2025.
That's a significant improvement in unit economics.
It is. And they also mentioned achieving over 60% centralized procurement for materials, up from 20% last year, and cutting customer complaints way down, below 10% now, from over 25%. Tangible progress.
Okay, and for rentals, how are they tackling that standardization challenge you mentioned?
Well, they're restructuring, moving away from having one manager do everything to having 6 specialized roles.
Specialization for efficiency.
Exactly. And shifting to a steady rent pass-through model with unified service fees, trying to make revenue more stable. And their AI human model is key here.
AI human model, explain that.
The goal is to have AI handle like 80% of the standardized tasks, things like pricing, auditing, paperwork, that kind of stuff. That frees up the human property managers to focus on the complex issues, the personal service.
Let the humans do the human stuff. AI handles the routine.
Basically. And they say its working productivity per property manager is up significantly. The average number of units managed per person has risen substantially, and they've grown their unit staff by over 50% in June compared to last year.
Interesting. Very detailed strategy there. What about this Beike business model, helping developers? Are they becoming developers themselves?
Good question. Management was very clear on this. No, they're not becoming developers. They're sticking to an asset-light approach.
They explicitly said that.
Yes, very explicitly. No asset-heavy model. They've got 2 existing projects they'll see through, but won't invest more than another RMB 1 billion of their own funds after those exit.
So what are they doing with developers then?
They're using their AI and big data for what they call C2M consumer-to-manufacturer solutions. Things like predicting optimal pricing, suggesting the best unit mix for a new building, providing deep customer insights.
So using their data to help developers build what the market actually wants.
Precisely. Helping developers adopt a customer-oriented mindset, which KE Holdings sees as like the crucial new variable in today's tougher market.
Yeah.
It's clever influencing development upstream without taking on the risk.
Very clever. Okay, let's circle back to that huge buyback. $5 billion authorized through 2028.
Right. And it's not just authorization. They've already repurchased about $2 billion worth since September 2022. That's roughly 10.3% of their total shares outstanding before the program even started,
So they're actively buying back shares.
aggressively. And this provides a really significant buffer for earnings per share during this transition. While margins are resetting and they're making these big long-term investments in AI and diversification, it just hammers home that management confidence.
Okay, let's shift to the outlook. Did they give any specific guidance for Q3 or the full year?
No formal quantitative guidance for revenue or EPS, which, honestly, given how dynamic that market is, isn't totally shocking.
Fair enough. What did they emphasize instead?
The focus was clearly on margin discipline and AI-enabled operating leverage, basically controlling costs and using tech to get more efficient, especially navigating this softer overall market.
And the macro picture certainly backs up that softer market comment, right?
Oh, absolutely. China's property market had a bit of a recovery in Q1, but that momentum definitely faded in Q2.
Why was that?
Partly international trade friction, partly the impact of earlier stimulus measures wearing off. Property prices are still soft, even with some easing policies, like we saw recently in Shanghai. And interest rates.
The benchmark lending rates, the loan prime rates, were left unchanged in August. Suggests the central bank is being pretty cautious. We saw nationwide new home sales actually drop 5.2% year over year in the first half of 2025.
So, yeah, a challenging backdrop, which makes their pivot seem even more necessary.
Exactly. It frames everything they're doing, the diversification, the AI push, the efficiency drive.
So, what does this all boil down to for you, the listener, whether you're tracking the market or maybe thinking about investing? Management does seem hopeful about potential government support.
Yeah, they mentioned possibly relaxing purchase restrictions more, urban renewal projects, things that could boost confidence. But for now, they're definitely navigating this with a very clear tech-focused plan.
Okay, so the takeaway.
This earnings call shows a company deep in a major strategic transition. That strong growth in non-housing rentals, renovation, it's absolutely essential to offset the pressures in the traditional brokerage business.
It gives them a more resilient revenue mix.
Exactly. But it does come with that near-term hit to overall profitability because those newer services just have lower margins, at least for now.
And the huge focus on AI-driven efficiency is critical. It's the linchpin, really.
It is if, and it's still an if, but if they can successfully use AI to boost productivity per agent per store, they could stabilize those unit economics and eventually maybe even expand margins again.
Proving that efficiency gains aren't just a zero-sum game against scale, maybe.
That seems to be the goal. And that massive extended share buyback, it just underlines management's belief that their stock is undervalued right now. It acts as a big capital return mechanism during all this uncertainty. It's a safety net, in a way.
So looking ahead, what are the key things to watch?
Definitely how China's property policies evolve. That's huge. Then keep a close eye on the continued ramp up and crucially the margin improvement in rentals and renovation. And of course the pace of that buyback.
Right. The next earnings report will be another important data point. Are these AI efficiency gains really starting to move the needle on margins?
That's what everyone will be looking for.
All right, let's switch gears. Time for our This Is Not Financial Advice segment, where we brainstorm some slightly adventurous but maybe plausible trade ideas based on what we've just discussed.
Always fun.
So, considering KE Holdings, challenging China market, but this clear pivot to asset-light, AI-driven services, strong growth in rentals, an interesting idea comes to mind.
Let me guess. Involves pairing it against something else.
You got it. Given the divergent paths within Chinese real estate, how about constructing what we could call a long-short AI real estate arbitrage?
Ooh, sounds fancy. Explain.
The idea is simple, really. You go long key holdings, ticker BEKE. You're betting on their ability to keep grabbing market share, and on this strategic pivot to AI and asset-light services, especially rentals and renovation, you're basically buying the tech transformation story.
Plus the strong balance sheet and that aggressive buyback.
Exactly. And then to hedge. You simultaneously go short a more traditional asset-heavy Chinese property developer, maybe an ETF, or pick a specific large-cap developer still stuck in the old model of land banking and just selling new builds.
Ah, I see. So you hedge the general China macro and property risk.
Right. While trying to capture the potential alpha or outperformance from KE Holdings' specific strategy, their efficiency gains, their platform model, the diversification.
So you're playing the divergence. The difference between BEKE's capital return policy and potential further pain for the traditional guys could create a compelling spread. It's a bet on the future of real estate services versus the legacy development model.
Precisely. A bet on the tech-enabled platform versus the old way. Again, purely speculative, not advice.
Definitely not advice, but an interesting thought experiment.
So wrapping up on KE Holdings Q2 2025, we've seen a company firmly in transition mode. They're navigating a soft macro environment with a pretty bold strategic pivot.
Yeah, balancing that solid diversification and commitment to shareholders against these near-term margin pressures. It's an ambitious play, really, with AI right at the forefront.
The story here is definitely one of adaptation, using technology, especially AI, to try and redefine what a real estate platform can even be in a market like this.
And the success of this efficiency-driven development, as they call it, that's going to be the key to unlocking long-term value. It might even offer lessons for other traditional industries facing disruption.
We hope this deep dive into KE Holdings earnings has given you some valuable insights, maybe sparked a few new thoughts for you. We really encourage you to keep exploring how technology is reshaping all sorts of industries.
Yeah, what other sectors do you think are ripe for this kind of AI-driven transformation? But what surprises might be hiding there? We'd love to hear your perspectives.
We really would.
And as always, please remember, the information discussed here is purely for informational purposes. It is absolutely not financial advice. Always do your own research and due diligence.
Couldn't say it better myself. Thank you for tuning in to The Deep Dive. We'll catch you next time for another deep dive into the numbers.